Welcome to RBC's Markets in Motion podcast, recorded February 17th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, there was very little change last week in the stats we monitor to track reporting season, aside from the continued drift lower in bottom-up consensus 2025 S&P EPS forecasts. Second, uncertainty, policy, tariffs, and FX remained in focus in last week's earnings calls. Third, we continue to find evidence of weakening vibes in the latest updates from AAII, NFIB, and EPFR funds flows. Starting with takeaway number one, mostly stable earnings stats. The percent of companies beating consensus on earnings is still tracking a little bit higher than the last reporting season. Meanwhile, companies in the Russell 1000 that are beating consensus are generally outperforming in terms of immediate stock price reaction, while those missing consensus on earnings are lagging. We're also still seeing a slightly downward bias to the rate of upward revisions for the S&P 500, but less pressure on the stat for the Russell 2000 small caps. The biggest things we noticed in our stats this past week was that in dollar terms, the bottom-up consensus S&P 500 EPS forecast for 2025 has come down a bit more and now stands slightly below 271, in line with our own current forecast. Though it closed near all-time highs on Friday, the S&P 500 has been essentially trading sideways around the 6,100 level since late January. We think investors are taking a wait-and-see approach to the busy news flow out of Washington, and the stock market's desire to tread water seems justified for an earnings perspective, at least for now. Moving on to takeaway number two. Uncertainty, policy, tariffs, and FX remained in focus on last week's earnings calls. Our team continued to read through S&P 500 earnings call transcripts last week. Some highlights. The theme of optimism being eclipsed by uncertainty that we've been highlighting in recent weeks did persist. In terms of optimism, strong demand in orders, M&A, economic resilience, and IT budgets were cited. Risks highlighted included currency, geopolitics, tariffs, trade, energy, and monetary policy. One bellwether industrial company noted demand has been constrained by uncertainty. Meanwhile, a tech company noted that they have seen some evidence of caution having an impact on customer behavior, though it had not yet translated into spending pulling back. As reporting season winds down, we find ourselves thinking it may simply be one Q25 reporting season before we get good color on how policy uncertainty is affecting current business conditions. Consumer commentary, meanwhile, remained light. We've been hoping to find clues on whether recent declines in consumer survey data might be reflective of any deterioration in consumer spending. Friday's retail sales decline and miss suggests yes. But so far, we're not getting a lot of color from companies in reporting season that helps to shed light on this question. The headwinds emanating from the strong U.S. dollar also remained a major focal point last week for companies in a wide array of industries. Some noted these headwinds would be stronger in the first half of the year. On policy, companies highlighted the uncertainties emanating generally and on trade, M&A regulations, food regulations, and SNAP benefits in particular. On DOGE, several companies highlighted the opportunity associated with a renewed focus on government efficiency. Tariffs were once again in focus, and commentary highlighted the fluid and uncertain nature of the current situation and references to mitigation plans and possible supply chain readjustments. Some companies that discussed the topic last week do have announced tariffs baked into guidance, while others do not. And as reporting season winds down, we see further downside risk to S&P 500 EPS from tariffs going forward. Wrapping up with takeaway number three, more evidence of weakening vibes. In our client meetings last week, we spent a lot of time highlighting how several categories of vibes, investor vibes, corporate vibes, and consumer vibes, appear to be fading to varying degrees. Last week's AAII survey provided further evidence of weakening investor vibes. Net bulls fell to minus 18.9%, taking the 4-week average down to minus 1.9%. We pay more attention to the 4-week average due to volatility in the weekly data points, but the drop in this indicator on the weekly data point was striking nonetheless. Bears have outnumbered the bulls in 4 of the last 6 weeks. The last time we saw sentiment readings like this was late September, October, and early November of 2023, when the S&P 500 experienced a 10% drop as Treasury yields soared. Readings like this were also common during the regional banking crisis of early 2023 and throughout 2022. Data out last week also suggests that small business vibes have taken a bit of a hit. After surging in late 2024 around the election, small business optimism fell slightly in the January update from NFIB last week. At the same time, small business uncertainty, which initially fell after the election, moved up sharply again, though it's still below last year's highs. The trends we're seeing on both of these time series also reflect what we've been hearing from public company C-suites in our earnings call transcript reading over the past few weeks. Digging deeper into investor vibes, U.S. equity funds flows, as tracked by EPFR, continued to move lower last week, but had not yet actually turned negative. Meanwhile, flows to U.S. bond funds continued to surge. The EPFR dataset also points to improving trends to Western European and German equity funds. The fade in U.S. equity flows broadly can also be seen in blend fund flows and large cap funds flows, particularly those to passive funds. What's interesting to us about this data set, in light of the AAII data, is that we haven't yet reached the point where investor anxiety is translating into outflows from U.S. equity funds, which has enabled the index to tread water. But it is reasonable to assume that this may be where we are headed, perhaps as more investment dollars shift abroad, if sentiment doesn't stabilize soon. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.